How to read annual report. First modern corporate annual report was published by U.S. Steel in 1903. It was certified by Price, Waterhouse and Company. Most annual reports have three components. The letter to shareholders. It gives the chairman's or CEO's overview of the company's business and financial performance. The business review summarizes a company's recent developments, trends, group structure, its geographical presence, and company's objectives. The financial review presents a company's business performance, management discussion, and analysis or MD, and audited financial statements, and other financial information. In MD&A, significant changes, industrial trends, macroeconomics are pointed out in narrative format or with charts and graphs. The financial statements consist of balance sheet, income statement, statement of changes in shareholders' equity, statement of cash flows, auditor's report and footnotes. How to read balance sheet. The balance sheet represents the financial picture for a company at the last day of financial year. The balance sheet is divided into two halves: assets, liabilities and shareholders' equity. Generally, assets equals to liabilities plus shareholders' equity. Both halves are always in balance. The assets section includes all the goods, property, and uncollected amounts due. The liabilities section includes all debts and amounts owed. The shareholders' equity section shows the shareholders' ownership valuations in the company. The assets section consists of current assets and other assets. Current assets include cash and those assets that will be turned into cash within a year from the balance sheet date. Cash and cash equivalents, this is money in bank, in hand and treasury bills. Marketable securities, these are short-term securities that are readily saleable like trading securities, held-to-maturity securities, available-for-sale securities. Accounts receivable, these are the amounts due from customers. An allowance for doubtful accounts is deducted from total accounts receivable. Inventory. Inventory usually consists of raw materials, work in process, or partially completed goods and finished goods. Inventory is valued at its cost or market price, whichever is lower. Prepaid expenses, those payments for which the company has not yet received benefits, but for which it will receive benefits within a year. All these heads sum up to total current assets. Other assets, property, plant, and equipment, or fixed assets. Fixed assets are reported as cost minus depreciation. Depreciation. Depreciation is the decline in useful value of a fixed asset due to wear and tear from use and the passage of time. It is subtracted from property, plant and equipment. Land is not subject to depreciation. Deferred charges, these are expenditures for items that will benefit future periods beyond 1 year. Intangible assets, these are assets having no physical existence like goodwill. These are gradually written off by periodic charges against income over estimated useful lives. The process is called amortization. Investment securities. All of these current and other assets are added together to produce total assets. Liabilities and shareholders' equity section has current liabilities, long-term liabilities, and total shareholders' equity. A current liability is an obligation that is due and payable within 12 months. Accounts payable, it is the amount company owes to its regular creditors from whom it has bought goods or services. Notes payable, it is the money owed to an entity under a promissory note and due within a year. Accrued expenses, money owed to employees, interest on funds from banks, fees to consultants are accrued expenses. Income taxes payable. Current portion of long-term debt. All these heads sum up to total current liability. Long-term liabilities are amounts due after 1 year like retiree benefits. Deferred income taxes, these are tax liabilities a company may postpone paying until some future time. Debentures, companies take loans from bondholders and in turn give certificates called bonds. Bond issue is called debenture. Bond interest is usually payable semi-annually. Other long-term debt, debt not reported elsewhere in balance sheet. Total liabilities, current and long-term liabilities are summed together to produce total liabilities. Shareholders' equity, this is total equity that all shareholders have in the company. Capital stock, or shares in the ownership of the company. Stock certificates are issued by the company to its shareholders. Preferred stock, preferred shareholder is entitled to a stipulated amount at par value, or face value, as dividend, before any dividend is paid to common shareholders, or else these dividends are accumulated. He has preference over common shares in case of liquidation. Common stock, it has no limit on dividends payable each year. In good times, high dividends are paid to common stockholders. Additional paid-in capital, it is the amount paid by shareholders in excess of the par, or stated value of each share. Retained earnings, these are the accumulated profits the company earns and reinvests in the company. Unrealized gain or loss on available-for-sale securities, it is the difference between the cost of available-for-sale securities and their market value. Treasury stock, when a company buys its own stock back, it is reported as treasury stock. Treasury stock is reported as deduction from shareholders' equity. Total shareholders' equity is the sum of stock, less treasury stock, additional paid-in capital, retained earnings, and unrealized gains on investment securities available for sale. What does the balance sheet show? Working capital, this is the difference between total current assets and total current liabilities. It shows the amount of current assets that is left if all current debts are paid. Current ratio, it shows how comfortable amount of working capital is available. Current ratio equals to current assets divided by current liabilities. It varies from industry to industry, though 2:1 is a good ratio. Quick assets, these are the assets available for sudden emergency or are quickly convertible to cash. Quick assets equal to current assets minus inventories, prepaid expenses, and any other illiquid current assets. Debt to equity ratio, this is to ascertain whether company is taking too much of debt or not. Inventory turnover, it shows how much inventory the company has on hand. Capitalization ratio, the proportion of each kind of security issued by a company is capitalization ratio. There should be a good balance of bonds, preferred stock, and common stock. The income statement shows how much the company earned or lost during the year. It shows the company's operating results for the whole year. It serves as guide how the company will perform in the future. It compares the revenues earned from selling goods and services or other activities against all the costs incurred to run the company. Net sales, it is the revenue earned by customers in exchange of products or services after allowance for discounts, returned goods. Cost of sales, it is the cost of purchasing raw material or services and converting into finished product in purchase. It involves material, labor and overheads. Gross margin, it is the excess of sales over cost of sales. Tangible depreciation and non-tangible amortization, it shows the decline in tangible and intangible. Selling, general and administrative expenses, like sales salaries and commissions, advertising, travel, payroll, and office expenses. Operating income, we get operating income by subtracting all operating expenses from the gross margin. Dividend and interest income, it is the revenue from investments, dividends and interest. Income taxes, each company has an effective tax rate. It depends on size and nature of business the company is doing. Net income, once all income and costs are considered, net income or loss, or the bottom line, is determined. Other items like R&D costs, investment in another company or ownership of subsidiary greater than 50% and less than 100% may also appear in income statement. What does income statement show? Operating margin and how it has changed over the years. Formula equals operating income divided by net sales. Net profit ratio. Formula equals net income divided by net sales. Interest coverage. It shows how readily the company can pay interest on debenture debt. It is number of times the annual interest on a debt obligation is covered by income for the year without considering interest on the debt and taxes. Number of times debenture interest earned, available income divided by debenture interest. Financial leverage. It relates long-term debt and preferred stock to the company's common stock. High leverage can work for or against the company depending on earnings available to common shareholders. Earnings per common share. Formula equals net earnings divided by number of common shares. Price-earnings ratio. Pay ratio equals market price of share divided by earning per share. High pay means that investors have confidence in the company's ability to produce higher future profits. The statement of changes in shareholders' equity. This statement analyzes the changes from year to year in each component of shareholders' equity. Preferred stock, additional paid-up capital, capital stock, plus paid-in capital, common stock. Retained earnings, total net income less the amount distributed to shareholders as dividends since initiation. Other items. Dividends. Dividends on common stock vary with the company. Dividend per share equals common stock dividends divided by common shares outstanding. Dividend payout percentage. This is the percentage of earnings per share paid to shareholders. Formula equals dividend per common share divided by net income per common share. Dividend yield. A percentage providing an estimate of the return per share on a given class of stock. Formula equals dividend per common share divided by market price of common stock. Return on equity. It shows how hard money works. Formula equals net income less preferred stock dividend divided by average stockholders' equity less preferred stock value. See notes. Annual reports usually instruct us see the accompanying notes, which are integral part of financial statements. Financial statements can't be fully explained on their face, so additional disclosures or notes are needed to explain. Some examples of notes are: description of company's policies, inventory valuation method, such as last in, first out, LIFO, or first in, first out, FIFO, asset impairment, investments, income tax provision, changes in accounting policy, employment and retirement programs, stock options, long-term debt, regulations or restrictions, auditor's report. The report from independent auditors should say these things. The audit steps taken to verify the financial statements meet the auditing profession's approved standards of practice. The financial statements are management's responsibility and follow generally accepted accounting principles. There is no material misstatement. How annual reports are used while investing. Annual report of a company should be compared to other time periods, report of other companies and industry averages. They can even be compared to macroeconomic factors. Many annual reports include 5 or 10-year summary of their financial highlights. The 10-year summary can show the trends and consistency of revenues, the trend of net earnings as a percentage, net earnings per common share, dividends and dividend trends, Some companies include changes in net worth, book value per share, capital expenditures for plant and machinery, long-term debt, number of employees, number of shareholders, number of outlets, information on foreign subsidiaries, foreign operations. Investors tend to know the present financial condition and future prospects of the company. The investor should also study the macroeconomics of the country and industry developments.